Did you know that Tesla stock will explode through a multi-trillion-dollar opportunity? While bears deem a Tesla stock soar highly improbable, others believe otherwise. Stay tuned and keep watching to know more. Tesla is almost always in the midst of a controversy. Even small comments or issues almost always blow out of proportion. That is not to say that some Tesla news are just that, newsworthy, especially when big names are involved. Today, you will find out why Tesla stock will explode through this multi-trillion-dollar opportunity. Tesla is positioned to enter several markets collectively worth trillions of dollars, according to Adam Jonas, a Morgan Stanley analyst. It can be noted that Jonas once stated, "Think of the EV race as a marathon. Tesla is in the lead at mile number 21. Everybody else is at mile 2 or still tying their shoes." In a research note published a few years back, Jonas said he sees Tesla becoming more of an infrastructure transportation company than an electric car company, and this evolution is key to its potential value. In the said note, Jonas identified several markets within Tesla's ecosystem it could address, including, but not limited to, a $10 trillion light vehicle mobility market, a $1 trillion logistics market, a $2 to $3 trillion energy storage market, and a potentially multi-trillion-dollar market based on delivering content and monetizing data collected during the 600 billion hours Tesla owners spend in their cars. Moreover, Jonas said that Tesla's data might be one of its most valuable assets. While difficult to quantify, Jonas wrote, "We have long felt that one of Tesla's most important areas of value is its captive ecosystem of data collecting transport machines with close proximity to data that may have any number of adjacent purposes for monetization and/or deepening of the strategic moat." Thus, Jonas said, any advances in electric car technology give Tesla an advantage in autonomous technology and a potential car-sharing business, while advances in autonomous can feed electric and car-sharing. Still, Jonas admits that there are risks to this. He said that Tesla may never develop the Tesla network car-sharing business Musk has spoken about, and on which Jonas is in part basing his investment thesis, and the company may end up being a niche electric car company. But Jonas, being a Tesla bull for good reasons, also thinks Tesla's autopilot system may offer tantalizing levels of safety to consumers. Jonas wrote, "Our discussions with auto companies and regulators suggest a high level of lawmaker attention to the unprecedented spike in fatalities on U.S. roads." He added that Tesla is aiming to produce human-driven cars that are 10 times safer than the average car on the road. In our opinion, anything even close to this order of magnitude of safety improvement could elevate market awareness, both the financial and the consumer market of Tesla's technologies, and the need to replace and upgrade the existing stock of used cars, said Jonas through the said research note. Do you think Tesla and its stock indeed have a multi-trillion-dollar opportunity? Share your thoughts in the comments section below. Today, assuming the entire car industry moves to electric vehicles, EVs could most possibly play a major part in re-architecting the renewable energy transport economy. Many believe that the world will soon operate on batteries, making the next battery invention and the materials that go into it the best way to profit from the multi-trillion-dollar energy transition's lucrative momentum. According to Bloomberg NEF, investment in the global energy transition reached a record $501.3 billion in 2020, and large money is pouring into new energy in a way that befits a revolution. More than that, institutions, foundations, and endowments with over $14 trillion in assets are poised to support an energy transition. Forbes refers to it as a paradigm shift. This is a substantial sum of money, and one of the investors' concerns with legacy automakers is that they have a sizable industry based on internal combustion engine vehicles. Legacy automakers are attempting to serve two masters with this massive commitment: internal combustion engines and electric vehicles. They can only serve one customer, and if it isn't electric vehicles, they will go bankrupt. Tesla, in its own right, is the leading EV company in the industry, a fact supported by numerous experts and analysts. According to Morgan Stanley, Tesla is both overvalued and undervalued. They believe that Tesla is expensive as a pure vehicle company, but it could be greatly undervalued as a renewable energy onshore infrastructure company. They see Tesla as the ultimate battery capex investment. According to Morgan Stanley, energy innovation will be rewarded as a result of two key events: war and inflation. With present circumstances, we believe that developments in the next 6 months will have a significant impact on the narrative surrounding what Tesla does, the markets it serves, its growth profile, and the global strategic implications of the ecosystem on which it sits. Many investors are also beginning to see the benefits of Tesla's direct-to-consumer model, something legacy automakers are unable to execute due to powerful state dealer franchise restrictions. Instead, it cuts out the middleman and reduces political play, therefore allowing the brand to properly serve its customers. Morgan Stanley believes that the multi-decatrillion-dollar battery capex cycle is being driven by larger causes. As globalization progresses into a new era marked by increased national security concerns, investors must consider the new energy supply and infrastructure. Battery storage will be critical in the future, and Tesla is well positioned to lead. Tesla will be able to produce more batteries than anybody else, as Tesla CEO Elon Musk has previously claimed that Tesla will likely start their own mining operations, either by acquiring mining businesses or starting their own from scratch. When Tesla's market valuation surpassed $1 trillion last year, doubts were quick to flitter around. This was a milestone previously only achievable by Apple, Microsoft, Amazon, and Alphabet. But thanks to a $4 billion deal to sell 100,000 vehicles to Hertz, a rental car firm, Tesla is right alongside them in that milestone. Still, it is worth noting that Elon Musk-led Tesla is in a different industry altogether from the aforementioned giant corporations. That said, although the electric vehicle leader eclipsed a market capitalization north of $1 trillion at the end of 2021, it now carries a market value of around $842 billion. However, long-term investors should be less concerned about short-term noise and focus more on the long-term trajectory of a business instead. That said, with the global EV market set to expand at a compound annual growth rate of 18.2% through 2030, according to Allied Market Research, Tesla looks to be advantageously positioned to capitalize on the rising trend. Tesla reported second quarter earnings after the market close on July 20th, and although growth wasn't exactly ideal, it was in line with what analysts were expecting. Tesla increased revenue by 41.6% year-over-year to $16.9 billion, finishing in line with Wall Street estimates, and its adjusted earnings per share climbed 56.6% to $2.27, handily beating forecast by 27%. Production and deliveries increased by 25.3% and 26.5% respectively year-over-year, but both retreated by 15.3% and 17.9% from the previous quarter. The slump in production and deliveries compared to the first quarter was attributed to the COVID-related shutdown in its Shanghai factory and ongoing supply chain bottlenecks, which have continued to hurt the global economy for quite some time now. Still, despite existing problems, Wall Street analysts project Tesla to grow its top and bottom line by 57.4% and 74.2% respectively for the full fiscal year. Those are impressive growth rates, especially since Tesla still has a couple of supply chain and production issues to smooth over. According to data from S&P Market Intelligence, analysts expect the EV frontrunner to generate $164 billion in total sales by 2025, indicating a 5-year CAGR of 25.4% from last year's revenue. Assuming an EBITDA margin of 25%, which translates to an annual EBITDA of $41 billion, the company would have an enterprise value of $2.3 trillion by 2025 at an enterprise value to EBITDA multiple of 55.6, which is where Tesla trades today. That represents a 175% upside from its current enterprise value of roughly $829 billion. At an enterprise value to EBITDA multiple of 151.3, which is Tesla's 5-year average, the company's enterprise value would reach $6.2 trillion, assuming it generates an EBITDA of $41 billion by fiscal 2025. It's not entirely realistic that the EV company would trade at such a high multiple several years from now, given that its growth will likely decelerate. On the other hand, a more conservative multiple of 25, which is still a premium to the S&P 500's average of 17.1, would yield an enterprise value estimate of $1 trillion, which is only 23.7% higher than its value at the moment. Visit Tesla stock and watch our other videos for more of this content.